Continuing with our coverage of where to find yield now, dividend stocks have soared this year thanks to their steady stock prices and high yields in a low interest rate world. And with interest rates expected to remain at zero, at least until the middle of 2015, we're asking whether dividend stocks are still a good place to find yield. Here to weigh in is Brian Peery, co-portfolio manager of the Hennessy Funds. Brian, welcome to the Wall Street Report. It's great to have you.
Thanks for having me today.
So what do you say? Are dividend stocks still a good place to find yield?
Absolutely. I mean, when you look at the 10-year yield on the U.S. governments right now, you're getting around 1.74%. You know, I think in our large cap value portfolio, we're looking at stocks on an average, of kind of a 3.95 yield. So you're basically getting, double the yield in the underlying securities. And then you get the chance of some capital gains on top of that. So, when we're looking at yields and we're looking at government yields, you're really getting what we term as a negative rate of return because inflation's running higher than the actual yield that they're paying you. So the only chance you really have to get income is going to be through equities.
So when you look at the dividend complex, though, are there certain dividend stocks that are more expensive than others? For instance, perhaps should people be looking past the typical blue chips like a Procter & Gamble to maybe lesser known names that have higher dividend yields?
Well, I think it kind of runs the gamut, to be honest with you. I think that there's still some really high quality dividend paying companies that, if you look at something like an AT&T that's still in the 4.6% range, that's obviously a widely followed, widely held company, and we still think there's some great yields there. And then you can kind of go outside that realm, and if you do look at some of the other, less known names, you can get yields that go, 7 to 8 to even 9% if you're willing to take a little more risk with it. So it really depends on the investor and how risky they want to be in their portfolio to kind of chase after that yield.
So Brian, when you're looking for stocks that have the potential to raise dividends, what are some characteristics that folks can look for?
Well, we basically do everything through a quantitative screens, and when we look at it, and what we're looking for really are companies that have top end in terms of sales, larger market caps. So we want to make sure that they're widely held companies. They're not just in a few holders' hands. And the one key characteristic that we always look for is we want to make sure that their cash flows are going to be able to cover those dividend streams. I mean, it's great that if you can get a 8 or 9% dividend on a stock, but if their cash flows aren't meeting that, then you know that at some point they're going to either have to cut that dividend or it may go away entirely.
So you mentioned AT&T. Are there other specific dividend stocks that you really like now that you could venture?
Well, I think you can kind of wade into the oils in here at this price range. I think you can look at Exxon or Chevron or some of the major players, or even go internationally to BP or Total in France that are some good dividend paying stocks. And if you can buy them with oil prices kind of settling in their lows here and figure that you're going to have a long-term time horizon, we think you're going to be fine in 5 or 10 years from now, and you're going to wind up getting a much better yield than you would in any kind of a government security.
Brian, there's the potential that the fiscal cliff could result in an increase in taxes on dividends. If that were to occur, does that change the dividend investment?
I don't think so. I thought when we originally lowered the tax rates down to 15% on dividend stocks, that would really be a big boon for dividend stocks, a number of years ago, and it never really transpired. So I think what people are looking for now is not only that yield replacement, but it's also that security, being in a stock where the brand names, that they've been around for a long time, and there's some sense of comfort there. And I think that that's why, these stocks have outperformed thus far this year as people kind of take that risk off approach and try and put some well-known, well-respected companies into their portfolios.
Brian, thanks so much for coming on the program and sharing your insight. I so appreciate it. Hope to see you soon.
Thanks. Have a great day.
Brian Peery, co-portfolio manager of the Hennessy Funds.